All right, thanks again, everybody, for joining us. Today we'll be talking about Quick Analytics CECLSolver, and as the time is almost up and everyone is busy getting ready for CECL implementation at the end, or should I say the very beginning of 2023. Just a couple notes about the presentation today. We are in presentation mode, which means that you can hear us, but we cannot hear you. If you have any questions, feel free to put them in the Q&A section on your GoToWebinar administrative box or in the chat, and I will try to get to them either during the presentation or after the presentation as time allows. And I am Steve Huntington. I am the Director of Analytics here at Quickrate and Quick Analytics. Sean O'Brien, our president of Quickrate, is typically here on these monthly webinars with me, but he could not join us today. I believe he is out of town at a conference, and so it is just going to be me by myself today. So bear with me if we have any technical issues at all. But my background is in working with community banks, as I've done for my entire career. All different types of strategic planning, valuation, and M&A advisory, capital planning, and model development and maintenance. I have worked with Quickrate for about a decade now, taking a lot of that experience that I had on the consulting and the corporate finance side and putting them into building these types of interactive financial tools for community banks around the country. Just a quick, brief introduction to Quickrate. The Quickrate deposit marketplace has been around for decades, but over the last 5 years or so, we have been focusing a lot on adding the Quick Analytics platform and as well as the IntelliCredit platform. I think the easiest way to understand the difference between the Quick Analytics side and the IntelliCredit division of Quickrate is the Quick Analytics side is more based upon the publicly available information that we're getting from all different sources. And we'll go into the details of what that means in a minute. Whereas IntelliCredit is more, the services we provide are more on the loan side, individual loans, where we can upload and ingest all of your individual loan data and provide dashboard and lots of analytics, as well as help you with internal and external loan review. Now, again, sort of we've already touched on this, but what goes into the Quick Analytics platform, if you were to subscribe to our CECL tool, you'd not only get access to the CECL tool, but the entire platform that is Quick Analytics, which includes not only lots of valuation information and comparative call report information on the bank side, but also comprehensive information at the consolidated holding company level. We now have integrated credit union data. So for any of you who are interested in looking at credit union financials side by side with bank financials, we can do that as well now. We have a comprehensive M&A database, so you can go through M&A transactions and do a lot of analysis from that perspective. We have full access to all the SEC financials as well. So if you're looking at larger institutions that file with the SEC, not only do we have financial information from the SEC and company reported data as well, but also a whole host of valuation, stock price information, summary of deposits information at the branch level, and everything else. The easiest way to think of Quick Analytics is there's sort of three sections to the platform. First section is what we call sort of bank and peer performance, where we have lots of sort of ready to go PDF, typically PDF type reports that are very board friendly, good for board reporting, good for comparative financials between your bank and your peers. Then we have the interactive side of the site, which is a lot more dynamic in choosing comparative information, looking at branch level information and holding company level information as well. And then we have our more in-depth regulatory tools, which certainly include the CECLSolver, which is what we'll be talking about today, as well as a comprehensive portfolio level credit stress test, a liquidity risk report, and a lot of other sort of dynamic interactive industry credit research. So sort of jumping right in, Sean typically handles the sort of general discussion of CECL and how it's come about in the industry, but I'll touch on a couple of the slides here before we dig right into what our CECL solver does and how it accomplishes the need. So first question that people are always asking, why CECL? How did we get here in the first place? Why did FASB decide that something needed to be done? The incurred loss methodologies that we'd all been living with for decades now seem to be getting the job done, plus or minus, until the last financial crisis. But we just realized that it was not adequately recognizing the risk in a lot of credit portfolios in an environment like we had never expected to be in, with the mortgage crisis as it was in 2008 to 2012, plus or minus. So FASB's solution obviously was to design CECL. Now, the first thing that we try to remind people is that despite the change in methodology for reserve accounting, what you end up with in building a CECL methodology doesn't really have to be very different from what you've always been doing with the incurred loss. We're playing the same game here, and we're playing it with the same people. We just have a slightly different set of rules. So talking about some of the differences and the similarities between the old incurred loss methodology and the new CECL standard, some of the obvious differences, CECL presents a much longer term, it's a much more cyclical approach to reserve accounting, as we're aggregating losses, and we're not thinking of things in any 1 year buckets anymore. We're thinking about everything over the remaining life of the assets. CECL also therefore becomes much more forward-looking, forward-thinking, and not waiting until it's probable that a loss has been incurred before we start estimating what that loss might be and building it more forward-thinkingly into the reserve. Another difference, or sort of difference, as more accurately, is the old concept of impairment, at least as defined in the old methodology, goes away. And it is replaced with the CECL standard, along with the FAS 5 and versus the FAS 114 reserves. But then I mentioned, we note here that, or does it really go away? Well, that's because, loans that exhibit unique risk characteristics and can't be reasonably pooled with any other loans still need to be culled from the herd under CECL, as they have been under the incurred loss methodology, and assessed individually. So the question becomes, what is the standard? What is that threshold by where we're supposed to take a loan that is, otherwise collectively pooled with other loans and strip it out and individually assess it? We had a better definition of what that threshold was under the incurred loss methodology. We had the threshold of the TDR, which is going to be going the way of a dodo next year as well. So that's not going to be particularly helpful moving forward. And we had the notion of impairment. However, again, the old definition of impairment sort of goes away under CECL, or is replaced with CECL, but we still need to find some reasonably justifiable explanation for the individual loans that we're kind of pulling out of the collective buckets and dealing with on a one-off basis. Another similarity between the old and the new methodologies are Q factors. Q factors are going to play a huge role in your CECL calculations, but they are not a new concept, right? Q factors have played a significant role in your ALLL calculations for years. When it comes down to it, it's all about making reasonable assumptions and justifying them. So, if we think, we've had lots of people who have kind of made an assumption that CECL was going to somehow be less subjective and a more objective evaluation of credit risk than the incurred loss methodology, and that's simply not the case. For anyone who thinks that we've somehow removed subjectivity in the process through CECL, we haven't. I would say there's probably more subjectivity under CECL than there ever was under the incurred loss methodology. And again, as I've already alluded to, who are we doing this for, right? We're playing the same game with the same people. And so we see lots of situations where an institution has started to develop a CECL methodology using our tool, and has done the math, and an examiner or an auditor comes in and looks at the books and says, looks like you guys have done a great job. You've definitely appropriately implemented one of the approved methodologies, or one of the preferred methodologies for CECL. All the math checks out. Now see if you can find a way to get your reserve to come out pretty close to what it's been for the last 5 years. So we have to recognize that, you know, who we're doing this for, and that makes a big difference in exactly how we want to approach CECL versus the old methodologies. Now I need to get to my next slide here. Hold on. There. Another slide that we typically discuss is, you know, from theory to practice, right? We've come a long way since CECL was originally introduced in the end of 2016 by FASB. You know, early in 2017 and in 2018, some of the early presentations that we saw done by FASB that they started to bring the FDIC in on discussed, you know, CECL from a very theoretical standpoint. And that's why we came up with a lot of the much more complex methodologies that were first developed and kind of displayed in 2017 and 2018. And they really didn't talk very much about some more straightforward methodologies that were going to end up becoming the norm for the majority of community banks around the country. And that's because, you know, it says the early theoretical considerations have been replaced by practical realities. Those practical realities are typical community bank doesn't have the resources or the data or the time to implement some of those much more complex methodologies that were being suggested early on by FASB. And so we saw about 18 months after FDIC and FASB started giving presentations on CECL that they kind of, I didn't say they went back to the drawing board, but they certainly came out and started talking about a different methodology that was mostly based at the portfolio level, took into consideration peer data at a high level in addition to historical data. And it was what they ended up calling the WARM method. And while our CECLSolver is not 100% solely based on the WARM method, it is mostly influenced by the WARM method. There are some elements of some other methodologies in our tool as well, but it is certainly based around the weighted average remaining maturity method. And for, you know, institutions, any of you who are on the call who might ask a pretty common question, you know, what size is the WARM method appropriate for? You know, once I get to be $1 billion in assets or $2 billion in assets, would I still be able to use one of the more straightforward methodologies like the WARM method? Or would I at that point be forced to completely change direction and start from scratch with a vintage or cohort or one of the more complex loan level methodologies? It's a good question. Of course, the FDIC and FASB never like to be pigeonholed with a specific answer, so they're going to beat around the bush. But the honest answer is that, you know, for community banks under $1 billion or $2 billion in assets, the more straightforward methodologies like the WARM method have been shown time and time again to be perfectly acceptable. Now, there's always exceptions to any rule. If you're an institution that's had a very significant issue from a credit standpoint, from an asset quality standpoint, maybe during the last recession, during the last credit crisis, in a particular part of your portfolio, or you have a very high concentration in a loan segment that historically had significant issues in your neck of the woods, in your marketplace during the last recession, then that's going to be an area where they're going to want to see a little bit of extra analysis or extra detail. But even if that's the case, it does not necessarily or typically doesn't mean you have to jump ship completely on a more straightforward methodology and get into a loan level methodology all the way across the board. You know, most community banks also don't really have all the necessary historical loan level information going back a decade or more to properly implement some of those more complex methodologies. And furthermore, something Sean always likes to point out is that, you know, depending upon what your actual loss experience has been, most of that extra analysis may find to be relatively worthless. You know, we've been in a pretty benign asset quality environment for a relatively extended period now. And so whether you're using really detailed loan level data or looking at things at the portfolio level and then also bringing in a lot of market data from peer experience at the segment level, if you've got a lot of zeros in there, right? If you've experienced no losses in a segment over the last decade, whether you're looking at it at an extremely, you know, detailed granular level or at a more aggregate level, you're going to come to the same historical loss experience, and you're going to find that the vast majority of your reserve is going to come from Q factors. And so that's the practical reality that most community banks are coming to, is that the majority of our reserve is going to be coming from these Q factors. So why do I want to spend a ton of time constantly reconciling all this loan level data in order to come up with a historical loss rates that are relatively close to zero, and then build most of the reserve from our Q factors anyway? Last slide before we kind of start digging into the actual tool itself. Some myths and realities about CECL, which I've already sort of discussed to an extent. There is no mandatory method for CECL. But no matter what methodology you choose, obviously, just like with everything else in CECL and reserve accounting, you need to be prepared to defend your choices and assumptions to your regulators and your auditors. Community banks under $1 billion, under $2 billion are not going to need to engage in some of those more highly complex and expensive models to satisfy CECL. We have found that, we have customers using our user base. We get this question a lot. What are some of the biggest banks that you guys work with? How many banks are currently using your CECLSolver tool? We have well over 200 community banks around the country that are using our CECLSolver tool actively as of today. They span in size from the smallest community banks, single branch, $20 million savings and loans institutions, all the way up to $4 or $5 billion institutions with loan portfolios in excess of $2 billion. So just because you've hit that $1 billion mark does not in any way mean you are now considered a large, complex institution that cannot use the more straightforward methodologies. That's not what we found to be the case at all. So why we introduced our tool, it's applicable to community banks of all sizes. It's a very intuitive, understandable approach to satisfying CECL regulations. You still can tailor it. It's very customizable to the unique characteristics and some segmentation of your bank's portfolio. And then we're there to help. We developed this tool in-house from scratch. Me and my team, that is my area and our area of expertise. And so when you have questions about the tool, it's not, you just rest assured that we're always there to help. If you call, you can talk on the phone anytime you need to with the people who actually built the tool. It's not something we acquired from some other, development group that we're just sort of trying to maintain. And that makes a big difference when you're on the phone with an auditor and examiner, that you can pull in the people that actually built the tool you're using to get any questions answered and to help as we evolve with the tool in the future. That's another important point, is that CECL has been very much a moving target, right? They've kicked the can down the road multiple times. They've made significant changes in what they suggest are the methodologies that they prefer over other methodologies. The Fed came out about almost a year ago now with the scale tool, which is something I'll also go through as we talk about our tool. And just last week, they talked about sort of an enhancement, I guess, to the scale tool, or what they call the ELE, the loss estimator, and we'll discuss that a little bit as well. But it's been a moving target, and so as we continue to listen to examiners and auditors as we move through the next year or two here, we're going to find that they have different expectations. Don't assume that your examiner knows everything about CECL the first time you discuss it with them. They're on the same learning curve here that we are. And as they get more educated on CECL and what it means, and get different marching orders coming down from on high, at the various regulatory bodies, they're going to have different opinions, more specific expectations of what they want to see and what they don't want to see with CECL. And as we get that feedback, we'll continue to enhance and modify our tool so it continues to get the job done for community banks. Some other resources that you'll have at your disposal if you were to subscribe to the CECL tool or to Quick Analytics platform. It comes with a user guide, a very visual step-by-step user guide, a methodology guide. We can provide you with drafts of implementation letters and policy language that'll help you get ready for CECL. We have and kind of an online library of some of the better presentations that have been done by FASB and the FDIC that talks specifically about CECL and talks specifically about community banks complying with CECL. We've just recently completed a SOC audit on our platform and on the CECL tool as well. So for any the banks out there that want that as part of a due diligence package to make sure that our model has been validated and everything else, it has. So we can help you with that as well. Now let's go. I'm going to jump ship here for a second, and instead of going through the slides, I'm actually going to pull up a live interactive version of our tool for a sample institution, and we're going to walk through exactly how the tool works. So bear with me here as I switch my screen share. All right, I believe everyone now should be able to see my my actual interactive screen here. So this looks exactly like the screen would look the first time that you log into the CECLSolver. Like I said, the institution that I'm using as our guinea pig for today is a pretty large community bank based out of Maine. But the only thing that I've done here is plugged in some weighted average remaining maturity values here, so you can see how that part of the tool works. But the first thing you'll notice when you log into our CECL tool is that it is preloaded with all of your historical financial data. Because we start, at least by default, with the call report, with the segmentation that we can get directly off of the call reports that you guys are filing every quarter, it means that we have full and complete historical access to all of your charge-offs and recoveries and balances and past dues by segment, going all the way back pretty much to the beginning of time, with some changes over time, of course. So it's kind of it's a game changer, and it really helps get you ramped up and get it in CECL very quickly to come on here and see all of your historical data pretty much there from the first time that you log in. Now, our data gets updated on a quarterly basis, obviously, as soon as everyone is filing their call reports. Once your call report is filed, then your data, at least your balance data, will update at the end of the month, at the end of that filing period. As soon as the that month is over and everyone's filed the call reports, the entire universe of data is updated within about a day or so in our database. And so there's very little lag in data. The other thing you'll notice is that peer data, just like it does in the rest of the Quick Analytics platform, peer data, I don't want to say it takes center stage, but it plays a very pivotal role in CECL, particularly obviously with our qualitative factor adjustments. And another benefit of our CECLSolver tool is not only is all of your historical data loaded the second you log in, but all of your peers as well. So you can build any custom, you can use a UVPR peer group, you can use a state-based community bank peer group, or you can build any completely custom peer group that you want. It only takes about 30 seconds to build a peer group. And as soon as you do that, all of their historical data is loaded and uploaded on the fly as well. When I say on the fly, this entire tool lives in the cloud. So it is interactive and very dynamic in nature. As soon as you change any input or any assumption throughout your CECL tool, the entire model recalculates instantaneously on the fly, which means that you get real-time feedback for when I made this change in assumption or value, what impact did it have on the reserve calculation for this segment and for the entire portfolio? It makes it a lot easier and quicker and more efficient to build scenarios. And that's really what you're going to want to do when you're building a CECL reserve is to come up with some different scenarios, right? Play around with peer data, play around with historical data, look at different qualitative factor adjustments and see what's really going to move the needle and what's pretty irrelevant in your situation. But you don't have to plug in 5,000 inputs, get an output, and then compare it from point A to point B. You can see immediately exactly what the changes are as you're working with it, which is one of the benefits of a tool. But you see, by default, we have all of the segments that you'd see on your call report. Because we're using the weighted average remaining maturity methodology pretty heavily, the WARM method, the first step in calculating and doing CECL under the WARM method is to get a handle on those average remaining maturities. It's really, honestly, one thing that you can't get around no matter what methodology you're using, because at its heart, what we're doing with CECL is estimating losses over the remaining lives of the assets. So we have to get a feel for what those remaining lives of those pools are. Now, the first question I typically ask, or the first thing that you should be looking at if you're considering the WARM methodology or considering using our tool, is where are you going to get those WARM calculations for the different call report segments of your portfolio? Obviously, the easiest way is if your core or ALM provider already has a report that you can request that has the WARM calculations done. We typically don't hold our breath for the cores to be helpful from that perspective, but sometimes they are, and that would be fantastic. But if not, fret not. If it's not something that you guys are calculating internally, it's something that we can certainly help you with. We have an Excel-based template that shows you exactly how you would calculate the WARMs on your portfolio if you need that assistance. And if you don't have the time or energy or resources available at the bank to do those WARM calculations, we can take over that entire part of the process for you. We would set up a secure way that we can get your individual loan data, and then we would do the WARM calculations for you and pretty much just present them to you on a quarterly basis moving forward throughout the length of your subscription. But typically the first step I'd suggest for people is to go ahead and take a look at our Excel-based WARM estimator tool. It's something that you can download and keep locally on your system and use however often you need to. I'll just open it up for a brief second here so you can get a feel for what that looks like. It's also organized by call report segment, just like our tool is. And for each segment of the portfolio, the only information that you really need to calculate a WARM, or at least an unadjusted WARM, is your current balance and the stated contractual maturity date. Obviously, there'll be some exceptions to that, like credit card loans and other loans that don't have a stated contractual maturity date, in which case we'll look at recent payment history instead as a proxy for remaining maturity. We can talk about that on a one-off basis if you have detailed questions about that. But you need balance and maturity date information, and then we need to make a prepayment assumption. And with that data, we can calculate a weighted average remaining maturity for each segment. We summarize them all here on there, and then those are the data points that we plug right into the tool. And once we plug in a WARM into the tool, the tool is often running and takes care of the vast majority of the number crunching for us. So let's pick a segment today to see and kind of work its way through the entire portfolio. Let's say we did a WARM calculation for our first lien mortgage loans, and we found that it was 9.25 years. As soon as I plug in 9.25 years here, it takes just a couple seconds, and everything just recalculated on the fly across the board as it pertains to CECL for our first lien residential mortgages. And what I mean by all that is, if we know that the remaining life of that portfolio is 9.25 years, we know what CECL is really requiring of us is that we project 9.25 years worth of potential losses going forward. Now, our tool, at least by default, it takes a symmetrical view of the look back period, meaning if we're going to project 9.25 years going forward, we're going to look at a 9.25 year period in your history and analyze your experience. How have your balances changed over that 9-year period? How many charge-offs have you had? What direction are those charge-offs now headed in? How many recoveries have you had? We'll take all that historical information to calculate what is, in effect, the first big piece of the puzzle for CECL, and that is, what is our bank's historical lifetime or life of the loan loss rate on that segment? And for the mortgages for this particular institution, it's 47 basis points. Now, obviously, there's a lot of math that goes into this value here, but since the WARM method is pretty straightforward and our approach to it is all the supporting data that you need to get to those calculations is right here on the historical analysis tab. So if I click on this tab, I can see all the call report information by segment that goes into those calculations. So for example, the first thing we're going to look at are balances, and we're going to track how those balances have changed. So we can go back in time if we need to, and we can see for the mortgage portfolio, it's grown significantly. It's almost doubled in size over the last decade for this institution, and it's averaged just under $1 billion in total mortgage loans over the period. You can see we've highlighted the look back period that we're using for each segment. So for those segments that have longer average lives, we're looking at longer look back periods, and you can get a very visual idea of what data that we're actually utilizing for the look back periods as well. If you want to modify or customize the look back periods, you can. This is a great way to sort of almost stress test your portfolio. Instead of using more recent call report, more recent loss experience data, if you want to go back and see, what would my CECL have looked like? What kind of reserves would I have needed if I were experiencing losses closer to what we saw back in 10, 11, 12, 13? You can go back here and you can shift your look back period further into the past to capture historical data from different points in time. But this is the balance data. Then we can get into the detail, dig into the nitty gritty on gross charge-offs. We can see the trend in charge-offs by segment going back in time. We can do the same thing for our recoveries, as they are typically lagging trends. And then down at the bottom where the rubber really meets the road is in the net charge-offs. So we can see how they've accumulated over time for this particular segment, adding up to a total of $4.5 million in aggregate net charge-offs over the entire look-back period, over the life of loan historical period. And I can always toggle over to ratios to see that in percentages, as we like to do, and see that that equals 47 basis points. So if I head all the way back up to the top and go back to the summary, that's all the data that goes into the 47 basis points historical lifetime loss calculation that we summarized here on the summary page. Now, all of this data that I just showed you would already be preloaded into the system and gets updated on a quarterly basis by our tool. So there's zero work for you to do from a historical data perspective. Once we have that, once we have your historical lifetime loss rates by segment across your portfolio, that's kind of the first half of CECL. Now, the second half is all the fudge factors, right? All of those qualitative factor adjustments that cumulatively represent all the reasons that we think current and future conditions might be a little different than the historical conditions, which resulted in the values we just calculated. So this is where the peer data really comes at center stage and can be extremely helpful. So if I click over here onto the Q Factors tab, this is where we can detail all those different qualitative factor adjustments, whether they be an adjustment based upon peer experience, based upon economic data, or based upon any other qualitative factors that you want to take into account. We're not going to tell you what all those qualitative factor adjustments are going to be. Well, I will discuss some common ones that, are not new to CECL at all. That list of 9 qualitative factor or environmental factors that we've been working off of that came from the regulators, years ago under the incurred loss methodology. As many of those as you see fit to take into account, you can certainly do so here. You can add other custom qualitative factor adjustments as you go. I've plugged in some default ones here just so you can see how the tool works. But as I click through the portfolio, you get to see kind of in one summary tab or one summary chart, you get to see what your long-term trend in losses is, what your peer group's long-term trend in losses has been. The gray shaded area is the look back period that we're using to sort of estimate CECL. And the orange line is the total CECL estimate based upon all of the inputs that we have at that point. So it's kind of a great visual summary of all the most important elements of CECL in one chart. So if I come here to the mortgage loans and let's say I want to make a sizable qualitative factor adjustment here based upon, let's say, some deterioration in credit scores or a change in portfolio mix, I click on that, and then this updates sort of on the fly. As soon as we make those adjustments, you can see the chart sort of updates on the fly here. Now, another sort of more of an administrative tool that we allow and we highly suggest that you spend time on is making notes as you go. So the tool allows you to come through here and make notes on what you're, start building that narrative that's going to be so important in documenting your reasons or justifications behind any of the adjustments you might be making via Q Factors. So you make your notes, make your build your supporting narrative here at the segment level, As soon as you make any of those notes, they get attached to the segment throughout the analysis. Whenever you save a scenario, whenever you export it, all your notes get organized by segment. So when you're presenting it to an auditor or an examiner, it becomes a very straightforward and efficient process of kind of walking through the portfolio, discussing the historical experience, discussing what's happening outside your four walls and the environment around you via economic data and via peer experience, and then going through what those qualitative factor adjustments are. To get into the peer experience in a little bit more detail, you'll notice here, right on the summary tab, we show your historical experience, and then we compare it to your peers' average historical experience. Now, all that data from the peers is coming from here. So really, when we were doing that historical analysis on your bank, right, looking at balances over time, going back as far in the past as we need to, aggregating charge-offs and recoveries for every segment of the portfolio, we were doing that entire analysis on every single other bank in the peer group simultaneously in the background. So just pulling in millions of data points from the call reports in order to get this. What this represents for your peer group, however you choose to define your peer group, whether it's all the community banks in your state, whether it's the 250 to 575 or to $750 million banks in these whatever 5 counties that you determine as your kind of more home market, you have pretty much infinite flexibility in building those custom peer groups. But we take all that historical loss and balance data and we aggregate it and do weighted averages of it by period to get this. This represents, you know, ignoring your own experience, how have your peers fared from a loss perspective at the segment level using apples to apples segmentation throughout history. And why this is so helpful and critical in your qualitative factor adjustments is I'm pretty sure that most of you on the call right now have at least one, if not multiple segments of your portfolio that have experienced negligible or literally zero aggregate losses over probably even an extended look back period. So how are we supposed to justify, we know we can't get away with saying, hey, you know, we've got $50 million in mortgage loans, but we have $0 in charge-offs there over the last 7 years. So we assume we're going to have the same experience over the next 7 years, and we're going to have a CECL reserve of 0 for our mortgage portfolio. Obviously, that's not going to fly. But we can't really just use our own historical loss experience to justify our reserve that we're going to need to make because, well, we haven't had any loss experience. So this allows you to go outside your four walls and look and say, well, let's look at all the mortgage loans in our county or in our state for similar sized community banks and look at their losses over that same historical 7-year, let's say, look back period. And so it gives you an idea of losses that have been in the market and what their trends have looked like, even if you haven't experienced those losses yourselves. So that gives you a very usable and defensible guidepost for some of these qualitative factor adjustments that we're going to be making. So that's how the peer data kind of integrates into the tool. We use that as one of our qualitative factor adjustments. We integrate our other qualitative factor adjustments, and then heading back to the summary, this is a summary of all those qualitative factor adjustments added up, a net adjustment. Once we make a net adjustment to our historical rate, we pretty much arrived at our expected future loss rate, right? That's simply your historical experience plus or minus the net of all your adjustments is equal to your expected future loss rate. And the last thing we need to do for CECL is apply that expected future lifetime loss rate to the correct portfolio. And what I mean by correct, not only does it need to be current, but it needs to be adjusted in some situations as well. So obviously, we're not getting your loan data on a daily basis for our interactive tool. We get it on an automated basis from the call reports every quarter. As soon as you file your call reports, this will get updated. However, that does not limit how often you use our tool or when you use it as of. You'll notice all these are overridable. So we'll pull in your March 31st right now. If you want to run this as of June 1st, for example, you'd simply come in here and override these quarter end balances with your current GL balances for your portfolio. As soon as you update the balances, everything recalculates on the fly and your CECL value gets updated instantaneously. This is also where you can adjust your current portfolio balances to exclude any balances that are outside the scope of CECL. So for example, if you still have a bunch of PPP loans sitting on the books for your C&I portfolio, let's say you had 10 million of those PPP loans in C&I, you'd come in here and say, all right, this is my current balance. I'm going to subtract 10 million for the PPP loans. I'm going to come in here and make a note and say we netted out 10 million PPP loans. So you can make notes on that segment there as well to remind anyone looking at this what assumptions you've made. If you have any significant government guaranteed balances from SBA portfolio loans, you can also subtract out the government guaranteed portions. Pretty much any balance that has no risk of loss, we don't want to be applying an expected future loss rate to that balance. And so we want to net it out of the what we call the population subjects to CECL reserves here. Once we've done that, the last piece of the puzzle is to pull out any of those loans that we've decided, even not knowing exactly what that threshold might be yet, that we need to individually assess. So we've added a tab here where you can come in and plug in either at the individual loan level or just at the segment level. You can aggregate, all of your, mortgage loans that you've decided you need to individually assess. Let us know what segment it's coming from so we know what bucket to pull it out of, so to speak, and plug in the impairment analysis information there. And then it'll calculate and flow back through to the summary here. It'll pull out those individually assessed balances so that we're not double counting reserves for them. And then once that's done, it can easily calculate the implied CECL reserve required for that segment. We add it all up for all the segments, and at the bottom we end up with a total CECL reserve on the collective pools. We then pull in the reserve necessary for the individually assessed loans. And then finally, we also have a module here for unfunded commitments. Now, I don't typically like to go into too much detail on these initial webinars about the unfunded commitments, but it is something that's going to have a renewed emphasis per FASB under CECL, right? There already is a spot on the call reports in the hiding deep in the other liabilities section that asks community banks today to whether they have any sort of allowance set aside for off-balance sheet credit exposures. Now, I also know firsthand that the vast majority of the community banks in the country are simply putting a 0 there on their call reports. That's not something I think that's going to fly moving forward, especially under CECL. And so the good news is that it's typically a very small piece of the overall CECL puzzle from a dollar standpoint. But we do need to make some calculation of a CECL reserve for unfunded commitments separate from the rest of our loan portfolio. And so we provided this module here to help you do that. It pretty much, it entails, looking at your total unfunded commitments by segment, which we can get from the call reports, as you can see here. So those are already preloaded into the system for you. Working with you to net out any unfunded commitments that are unconditionally cancelable. So FASB has deemed that of your unfunded commitments, those that are that you don't have to jump through a lot of legal or regulatory hoops in order to cancel, you don't need to worry about from a CECL perspective. A good example of those would be credit card. Unused credit card balances are pretty much the definition of unconditionally cancelable. Once we net out those, whatever's left over is what we call the net unfunded commitment. That's the balance we need to deal with from a CECL perspective. And once we have that, we kind of have to jump through some mental hoops here, right? Because in essence, what they're asking you to do is they're asking you to project future long-term losses on loans that don't really exist yet, right? So it's already kind of very hypothetical in nature. But we have to go through the exercise of estimating the probability of funding, and then how long are these commitments for, and then what kind of losses might we see if they were to be funded. Luckily, we have some great default values here to help you along your way. We've just done a study on what type of losses you might see on your portfolio, so we can pull that data in for expected loss rates here. As far as estimated probability of funding, that's something a typical community bank does not have a great handle on, and that's not surprising. at all. So we give you some good data from the FDIC in their credit conversion factor research that they do in the regulatory call report schedule, RCR Part 2 type information. And so we can help you with that. But this is not something you need to spend weeks pulling your hair out about, because it's probably going to amount to a very small piece of the puzzle. But we do add it in there that you can utilize if you need to. That feeds into the summary right here. And then we're left with a total CECL requirement. We compare it to your current reserve at that point in time, and we let you know what your CECL surplus or shortfall might be as of any point in time. So that's pretty much how the tool works on a step-by-step basis. Now, from an administrative standpoint, once you've built a scenario the way you want it, you can save it very easily. You just come in here and say, save as new scenario, test June 2022, for example. I create it. As soon as I've done that, now everything, all my work has been saved. You can come up here and access that scenario anytime you want to. You can create as many scenarios as you want to. There is no limitation to how many scenarios you can create over time, or how many people you have accessing them. We don't charge extra for extra seat licenses or any of that kind of stuff. A best practice is to create a large number of scenarios over time. So this becomes a repository of all your saved CECL scenarios as we go through this year and into next year, so that you can demonstrate to your examiners exactly what it is that they're asking for at this point in time. And that is, do I have a solution for CECL? Do I understand the methodology? Do I have a good handle on what my surplus or shortfall on day one is going to be? And am I tracking the changes to these scenarios over time, right? As we move through this economic environment and get closer to next year, things are going to change. And you're going to want to keep track of exactly what those changes are. So as you save scenarios, you can toggle between May and June and July and see pretty much in real time exactly what's changing from period to period. Another important, it's another important thing as you share this with your board, maybe on a quarterly basis, or with your auditors. If you see a huge difference in your reserve from one quarter to the next, you're going to need to be able to explain exactly where that came from and what the reason for it is. Our tool makes that extremely easy to pinpoint the changes over time and explain exactly where those are coming from. Same thing for creating multiple scenarios, right? Another best practice we highly suggest is have a couple different qualitative factor adjustment scenarios, a more optimistic one and then a more pessimistic one, and put them side by side so that you can create potentially a range of reserves that you can share with an auditor or an examiner, depending upon how they see the world from an economic standpoint. Even if it's a range, honestly, at this point, that you can drive a truck through. It gives you some ammunition to get to kind of put the onus on them to say, hey, here are some different scenarios we've run. Where's your level of comfort? And kind of force them to give you information as to where they think your reserve should be, which can help guide you as to which scenario may be most appropriate moving forward. Again, not only can you view all these scenarios in the cloud, but of course you can export them anytime you want to into whatever format you want to. So when you click export, you have total control over how much of a tool you export. You can select everything if you're sending it to an auditor or an examiner, or if you want a quick board summary, you can just export the summary results or some of the historical detail and maybe some of the Q factor detail and some economic data. You choose that, and let's say you want it as a PDF, you click PDF. It takes just a few seconds and it builds an Adobe PDF right here in a new tab in your browser that you can download and send externally as much or as little as you want. You can pull it into there, or you can also export everything directly if you want into an Excel environment. The great thing about exporting into the Excel environment is that it allows you to make any other notes. You can add columns, you can add rows, you can do other ancillary calculations that you can add into the tool, but it still retains all the spacing and shading and general formatting of the interactive tool. So I just pulled the tool into the Excel environment, and you can see here it still has the color coding and shading of the look back periods, those visual look back periods, the peer data if you want it, all those qualitative factor adjustments. So very flexible in how you export that data so you can get what you need in the environment you need to get it in to satisfy everybody. I know I'm sort of starting to run short on time already, so I'll kind of go a little bit more quickly through the rest of this. Again, we have that resources tab. There's a user guide here, step-by-step reminding you of how to use the tool, the methodology guide and a white paper, some implementation letter language, that warm estimator tool, that's an Excel-based tool that you can utilize, the results of our SOC audit there, some of the other industry accounting resources. We're going to be adding some other resources that'll help you make assumptions about prepayments. If you need some help on prepayment assumptions as well for those warm calculations, we can provide some of that as well. And we also, again, we went ahead and decided to sort of recreate the Fed's scale tool that they introduced last year. We know that the scale, for those of you that are familiar with the scale tool, it's a relatively watered down tool. It is certainly not a safe harbor for a CECL compliance, but it was the Fed's attempt at utilizing portfolio level data and utilizing peer data in order to help come up with to help guide you for CECL. We thought it was helpful enough, and simply is whether you were looking for a secondary methodology to help justify or compare your primary methodology to for CECL. If you click on the scale tool, it's going to open up a new tab here. And again, this is not us sort of trying to improve upon the scale tool. We believe that improvement is our CECLSolver, but we wanted to kind of faithfully recreate the scale tool so that you can certainly do a CECL calculation based upon it right within our platform. And you can save scenarios here as well and export the tool. So this looks and works exactly like the Fed scale tool with all of its benefits and faults. And we're happy to walk through that with you on a one-off basis if you want to look at it in more detail. At this point, I'm going to go ahead and shift back to the PowerPoint presentation to finish us up. So give me one more second and bear with me as I do that. All right, so everybody should be seeing my PowerPoint presentation again. I'm gonna just kind of, I made sure that I cook a couple screenshots from our interactive tool and put them right into the PowerPoint presentation. After we're done today, we're gonna go ahead and send everybody a link that has a copy of the whole presentation along with the audio and video from the presentation today, so you can share it amongst your coworkers. And but I wanted to have right in the slide deck, if you're printing out a PDF of the presentation, some slides from the interactive demo. So this is just kind of a summary of how the tool works and what data is available. Again, I took a snapshot of our scale tool there, so you have that to print out. This is just another page that shows where that data is coming from, specifically for the scale tool. One of the challenges in implementing scale is the data. Fed didn't do a great job of giving us really good customizable data to use for the peer disaggregated reserve information, which is so central to utilizing the scale method. So we present that data. So one of the pages you can go to and look at the disaggregated reserve information that exists on all those larger banks, the over $1 billion banks that are filling out that Schedule RIC information, where you can see reserve information by segments. Now there's only, there's limited segmentation available on Schedule RIC, but at least you can get a feel for what the larger community banks in your neck of the woods are doing from a reserve perspective in some different segments of the portfolio and track it over time. Next slide. We're also, again, as I mentioned earlier, we're always making enhancements to the tool, making sure it continues to meet our customers' needs. As we have users that point out things they'd like to see added to the tool, we discuss it with our internal accountants, we discuss it with FASB, we discuss it with the FDIC, and then we add things whenever necessary. We felt it would be helpful to give some more detail on potential qualitative factor adjustments. So we're currently finishing up an enhancement to the tool, which allows you to kind of add in those common qualitative factor adjustments that that came from, you know, the OC, that sort of regulatory round, the interagency policy statement on ALLL stuff, which you're probably all very familiar with in your current reserve methodologies. Oh, I missed something. Yeah, we also are finishing up a template for the ACL adjustment for held to maturity securities. That's a small piece of the puzzle, again, sort of like unfunded commitments is. It doesn't apply to some community banks at all. The community banks it does apply to, it's relatively limited, but FASB has deemed that under CECL, for all of your held to maturity securities that have real credit risk, the ones that are not government guaranteed, we'll also have to have an ACL adjustment, a CECL adjustment for those securities as well. So we're finishing a template to have you so that you can plug that information directly into our CECLSolver as well. That should be available, I think, probably next week, actually, or at least 2 weeks from now at the latest. Want to make sure there's. So I think that's pretty much all that I wanted to cover today. I don't see any. Let me see if I have any questions. I don't see any questions on here yet. If you have any questions or want to shoot something through the chat, now would be the time. Otherwise, the next step would be for, if you want to have this kind of a demo with all of your data on a one-on-one with either me or one of our sales members here, we'd be happy to do that. So give us a buzz, shoot us an email, and we'll schedule, you know, an hour where we can really dig into your loan portfolio and you can see how it looks on our CECL tool. We can give you access to it to play around with as well. And just rest assured that, you know, CECL does not have to be such a burden. It can be relatively straightforward. It can look a lot like what you're currently doing for your reserves, just with some, you know, differences in how we look at the data. And we're there to help you kind of walk through it step by step. We do this thing every month now. In addition to these kind of informational webinars where we're going through the tool, we've also started what we call a coffee talk. We're doing this once a month. We started back in December, so we've done about 6 of them now. It's a very informal format where we take questions from the audience, from all of our users. We take questions and we bring in auditors, and we haven't yet been able to bring in anyone from the FDIC directly, but we're working on that. But we bring in accountants and auditing firms to lend their thoughts on CECL and the methodologies, and we allow you guys to ask direct questions of them and of us. Sometimes we have, you know, some best practices or questions we get asked frequently that we'll kind of use to lead the presentation, but it's a very back and forth flexible format, and we've been having a huge feedback, positive feedback from those Q&A sessions. I think last month we had almost 200 community bankers on our coffee talk last month, so it was great. Fun was had by all, even though the content was about current expected credit losses. But we would love for you to join us next month on July 15th. Register for that. Even if you can't make the coffee talk, go ahead and register for it, because if we get your email through the registration, we'll make sure that we send out a copy of the whole presentation and you can watch it some other time. So again, thanks everyone for taking the time to join us today, and feel free to reach out, and we'll go through the tool with you and discuss pricing. Again, CECL is part of the entire Quick Analytics platform, but for the price that you get CECL, pretty much the entire rest of the platform you get free of charge, depending upon how you want to look at that pricing. But it's very affordable, and it's done on a subscription basis. Thanks everybody again, and hope you all have a good rest of your week.